Since Monday, evidence gold and silver being sold into a declining dollar index. Now, that is the inverse of what you would expect because there's a cross there.
Andrew Maguire explains that there was a banking crisis last week that initially resulted in short-term bullish price containment action in the metals, but that containment was eventually overrun as officials intervened in an attempt to paper over a widening derivative chasm. Despite this, technical chart damage was inflicted, catching out paper market sellers. The breakout of the capped ranges incentivized central bank physical bidders to up their physical support levels, which changed the market from a sell-the-rally market to a buy-the-dip market.
Andrew, we've had a ton of questions related to the gold and silver market volatility. Can we start off with what you're seeing right now in this wildly swinging gold and silver action?
Yeah, and wild swinging it is. Yeah, Shane. So I guess really we start with last week, we saw the beginning of the unfolding of the banking crisis, which initially evidenced very short-term, bullish, but clear price containment action in the metals. That was last week. And that was just after the first bank collapse last Friday. Then we saw a little bit of a scramble to cover, and then it was followed by a full-blown spillover on Monday. Remember, they were panicking over the weekend, trying to find a solution. And so basically, this leveraged paper market containment was overrun as officials really intervened in all the market crosses, though, in an attempt to paper over the widening derivative chasm. And it is a chasm.
Andrew Maguire discusses how the Swiss government bailout of Credit Suisse was coordinated with the Fed and the BIS in an attempt to stem a potential $1 quadrillion derivative implosion. This triggered a race into gold and led to breaches of officially capped January 2023 highs, as well as April 2020 highs made after the March 2020 global bank bailout.
Officially sanctioned Swiss government bailout of Credit Suisse, that was coordinated with the Fed, the BIS, really trying to stem a daisy chain collapse of the too big to fail banks, underpinning a potential $1 quadrillion derivative implosion. And that triggered a race into gold. Go figure. And not only taking out the officially capped January 2023, it was at $1,975 was the high in January 2023. But it also took out the April 2020 2003 dollar highs, which were the highs made just after the last, if you remember, the March 2020 global bank bailout. And these were the highs that were made after that. Now, look, these breaches have not gone unnoticed. And because what it's done, there was a lot of short layers there, which were just rinsed. Now, this money didn't go nowhere. It was rinsed right out of the short positions. Now, as part of the attempt to soothe the markets, obviously we immediately evidenced official interventions in all of the crosses, which, when we talk about crosses, which in gold and silver, it's the paper gold markets, basically. And obviously governments openly intervene in the FX markets all the time. They admit that they do. And so really it was no surprise to see them, and gold and silver are foreign exchange crosses.
Andrew Maguire talks about how officials have been intervening in all the market crosses, particularly in the paper gold markets, as part of their attempt to stabilize the markets. Gold and silver are foreign exchange crosses, and governments openly intervene in the FX markets all the time. Additionally, there have been last deliverable evidence and physical delivery regulations that force compliance in net stable funding compliant silver positions. As paper-to-physical conversions flow through and hit the cartel.
Every day, we've also been evidencing last deliverable, and remember we talked about T+2. This is physical delivery. These are net stable funding compliant silver positions where you go into the fix, you buy that, and you are, as of this year, you are forced to deliver those that bullion. And that is called T+2, meaning that you buy it today, you will get delivery in 2 days, because that is what NSFR regulations force compliance of. So obviously, when you lock in each PM fix, you lock in these prices, and they've been in the 1900s. So as these paper to physical conversions flow through and ultimately hit the cartel, these central bank sovereign spot gold orders, and they are central bank spot gold orders, have to be hedged, meaning short covered, by the agent bank insiders exposed to delivery obligations they are in absolutely no position to fulfill.
Andrew Maguire discusses the physical delivery outflow of gold and silver in the global market, which is counterintuitive to the official efforts made to intervene and keep the bellwether gold from undermining their efforts.
Now, we'll continue to see these physical delivery outflows into blatantly counterintuitive official efforts which we've been seeing. And the efforts are to intervene as they attempt to spin that, look, all is well in La La Land.
Andrew Maguire talks about how the rising gold price is an indication that all is not well, and officials have been actively intervening in all crosses in a globally coordinated mandate to try and keep bellwether gold from undermining their efforts.
Goodness me, anyone that cares to look under the surface will realize that is not the case. A rising gold price, though, is a barometer that all is not well after all. And to reaffirm other reports that we've been getting right across the globe, that officials have been actively intervening in all of the crosses in a globally coordinated mandate to try and keep bellwether gold from undermining their efforts.
Andrew Maguire highlights the inverse relationship between the dollar index and gold price, where the declining dollar index is leading to a declining gold and silver price.
Footprints since Monday evidence gold and silver being sold into a declining dollar index. Now, that is the inverse of what you would expect, because there's a cross there. And we talked about this before, and it's usually inverse. And this time, the dollar was crashing on Monday, on Tuesday, and today on Wednesday when we were recording this. The dollar was actually declining, and gold and silver were either declining or being capped into that. So it's so obvious. These intervention efforts rely, though, on paper gold being sold, short sold, but once again, limited to rinsing the margined CTA longs. These are the speculators who never take delivery and who always race on board as the right price rises. But in this case, they raced on board as the crisis unfolded. But while officials try and spin this a risk on sentiment back again, everything's fine, invest in risk, invest in stocks, to force these very same CTAs who'd raced into safe havens to then dump these positions in favor of risk, it is serving to incentivize strong competing safe haven physical demand, which continues to be reported since last Friday. Now, when netted out of the sticky CTA longs, these are the guys that are in for the long haul, the resulting paper market backfilling, which is what we've been evidencing, will run out of weak-handed speculators to rinse. And ultimately, this is going to be helpful in cementing a higher stairstep that we've been looking to discern a level above 1900.
Andrew Maguire discusses how the physical golden and silver markets in Asia reflect a strong safe haven appeal in a global bailout of an extremely fragile broken banking system.
Now, obviously, this is something that's unfolding. So into the official paper market interventions, the physical gold and silver markets in Asia continue to reflect a strong safe haven appeal into what is undoubtedly a global bailout of an extremely fragile, broken banking system. It is perceived that many more banks exposed to liquidity issues will be exposed over the next few sessions. And while the mainstream media assisted globally coordinated efforts to prop up the large too big to fail banks is front and center, under the covers, it is the regional banks who actually provide over 80% of all lending that still expose these too big to fail banks to a potential domino collapse effect. Now, currently, the FDIC at maximum only has around 2% in the kitty to cover all these bank deposits. So invoking emergency measures, which they've been discussing to back up the FDIC to cover all deposits, what's that's going to do? It's going to trigger a massive inflow into gold, bonds, and all safe havens. You can't hide these footprints. And despite official efforts to interfere in the crosses, the gold is set up very similarly. We talked about this the last 2 or 3 times. Very similar to when it commenced a $1,200 rally in October 2008, which was another. But this crisis is even worse. Look, also, silver will be dragged up higher by gold, draining deeply underwater COMEX and global inventories in silver, which are really thin, breaching short stops. Now, these short stops are bets that were made against silver, and they are margined, and it's the same speculators, in this case, who have no ability to deliver these positions, will actually be rinsed of these positions, and there is sufficient size stops, i.e. buy orders, to get out of these positions to breach the all-time May 1st, 2011, $49 highs.